Wall Street says commodities are risky, but explain this. Sugar is 14 cents a pound, oil is $98 a barrel, and in 50 years that gap has never closed without a violent repricing in one direction. And one ratio has predicted every commodity cycle since 1971. It just hit its lowest level in history. This chart measures relative value of commodities versus equities since 1967. In 1971, it hit 0.9 as Nixon closed the gold window. Within 2 years, oil tripled, wheat doubled, and the ratio ran to 8.1. In 1999, the ratio hit 1.5 as every dollar chased tech stocks. Cue the Chinese boom where commodities outperformed the S&P 500 by over 300%, and the ratio ran to 8.6. So today the ratio sits at 0.6 below both historical floors. In both past cycles, these bottoms triggered decades-long commodity bull runs. Past results don't predict the future, but the pattern is exact. So before we dive into today's shocking data, hit the subscribe to track these cycles with me. Now the reality on the ground. This is the retail cost of urea, the primary corn fertilizer in America. It just hit $840 per ton, up 34% in 1 month. Of course, the catalyst is the Strait of Hormuz. Despite the April 7th ceasefire, shipping companies are still rerouting, natural gas and crude are choked, so fertilizer manufacturing remains bottlenecked. This next chart demonstrates maximum cost squeeze. Farmers now need to sell 133 bushels of corn to buy just 1 ton of urea, the worst ratio since 2022. If you value hard data the mainstream ignores, please drop a like. Because meanwhile, corn and wheat are trading below the actual cost of production for many US farmers. So today's USDA report confirms investors are blind. The media sees elevated wheat and corn stocks and calls it bearish. But they're ignoring this line. Wheat use was lowered for reduced seed use. Farmers are literally planting less seed because urea is unaffordable. As for sugar, the USDA just cut domestic beet supply projections while human consumption deliveries accelerated higher. More importantly, with oil near $100 a barrel, Brazilian mills divert cane directly into ethanol. This price floor nullifies any global surplus fears. The market is pricing in a perfect harvest optimism while ignoring the brutal input cost mechanisms destroying it. So how do we play this? Here are the exact instruments I trace. I watch tickers wheat and corn for grains, or TILL for broad exposure without K1 tax hassles. Instead of the cane ETF for sugar, I prefer Cosane SA, ticker CSAN, to capture ethanol diversion and to directly play the fertilizer bottleneck. I rely on nitrogen producers CF, Industries, and Nutrien. And finally, my invalidation protocol stands on 2 levels. If crude oil breaks below $78 a barrel, energy costs weaken, and if average urea retail drops below $620 a ton by June, supply destruction is neutralized. Let price action dictate reality.